Hey, good evening, everyone, and welcome to tonight's live stream. I'm very excited to share this with you. We're going to do a different format today, and that is we're going to be talking about the top questions I was asked over 2021. These were the three top single biggest questions, and I hope you enjoy these questions. By the way, welcome to the live stream. I go live every Wednesday at 7 o'clock, and we talk about all things financial planning, whether that is retirement planning, estate planning, financial planning, what's going on in the markets, life insurance. I'm an active advisor, so I'm not just somebody that does videos. I actually manage money and do insurance products, group plans, work with individuals, families, and business owners. If you cannot hear me, please let me know in the chat. I really need to know that the volume is working just fine. And you can just give me a thumbs up if the volume is fine. If it's not, I'll try to figure that out. Tonight, we're going to be answering your questions as well. So if you have any questions, go ahead and put them in the into the chat. We're live streaming across Facebook, LinkedIn, and YouTube. And so you can use any one of those platforms to go ahead and put your questions in there. So I have three of the top questions that were asked of me in 2021 and continue to be really the top three questions. And if you have any particular questions, I'll try to answer those as we go on the fly. And so if there's no questions right off the top, I'm just going to head on into this right away. And remember, if anyone is watching right now, if you could just give me a thumbs up on the volume to make sure that you can hear me just fine, please. And that would be great. Okay, we're going to go through the first, and I'm actually going to start with the number one, and I'll just work our way to the other two. And so the number one question is really, will I have enough money to retire? This happens to be the number one question. And you'll be able to, if you want to take notes, you can go ahead and watch this video later on in YouTube when I've done the editing of it. And that way you can go back and make some sense of what I'm talking about. But let's have a look at how do we arrive at making sure you have the enough money to last. Hey, Ivan, great to see you. And thanks for tuning in today. Hope everything is well out there. Okay, so how do you make sure you have enough money to retire? Well, the first thing I want to just back up one step and say the retirement zone. If you're 5 years before retirement and 5 years into retirement, you really want to make sure this is not your number one question. Because if it is your number one question, then you probably have some work to do. And it's no panic at all. You just have to make sure that you have all your ducks in a row, and I can share with you how that works. But essentially what you want to do is try to minimize the amount of severe negative returns in your portfolio the first 5 years before retirement, and the last 5 years before retirement, and the first 5 years into retirement. And the reason for that is because one, you don't have enough time in front of you to make up any losses if they're severe. And the second is, when you're doing withdrawals out of your account, when you have negative returns and you're doing withdrawals, it just amplifies the degree to which your portfolio is going to continue to go down. And so that's really important that that doesn't happen. So the way that you prevent that is actually you get a financial plan done. Financial plan, I say this in every single video has this, and I talk about it. It is seeing the outcome of your planning decisions before you actually commit to them. A financial plan is not difficult to do. And I know that in talking with people, like 2 out of 10 have financial plans. Hi, Rosemary. Great to see you. I'll get to your question in a moment. Financial plans are so critical, and 2 out of 10 people have a written financial plan, and it might go to support this anxiety that generally everybody has. The number one question is, will I have enough money to retire? And then when you look at 2 out of 10 people actually have a written financial plan, it's probably a good reason why they have anxiety about retirement and will their money last, or will they be able to save enough? Different variations on the same question. And so, I can share with you a conversation I had with a client 2 nights ago. And it was really around that. It was around, let's talk about your financial plan. Let's work through it together. This was a Zoom call. We didn't have to go to each other's homes. We did everything over Zoom, and I started to take information in to my financial planning software and real time show them exactly how their current situation was, and they didn't need a reminder of what their current situation was like, and then show them exactly what it was going to look like the moment we implemented those changes, how that was going to make everything so great for them. And the like watching the body language, the anxiety drop, the taking the deep breaths, the feeling of reassurance that everything was going to be just fine. It's invaluable, right? How do you measure that kind of reaction in a person when you can share with them that their financial plan and their retirement plans, everything is going to work out just fine. All we have to do is these kind of things, and you're going to be just fine. And so let's talk about what are these kinds of things. Here's one of the things that you get in a financial plan. Now, a financial plan is 18 to 30 pages long, but what's important here is these next few slides. One is cash flow. Without getting into too much detail, but what this is really saying is that gray line that kind of goes jagged, across and down and up again, that is what the person has said to me, David, this is how much money my retirement is going to cost. I need to have so much money every single year throughout retirement. And in this case, we see it's starting off about $125,000, $130,000 per year, and it climbs all the way up to age 70, and then it drops because the person says, you know what, I'm going to actually probably not travel as much, and I won't be as eager to go see the world. I kind of want to stay home more than I want to explore early in my retirement. So my need for capital is going to diminish over time. It's going to go down, even though that the requirement goes down in this particular example for a need for annual or monthly capital. You can see that blue area that is well above that line, that gray line going across there. So that tells them that they have way more money than they're actually going to spend in retirement. And it goes like into all the retirement sources, whether it's CPP, old age security, what kind of retirement products, tax-free savings accounts, non-registered accounts, if they have corporate assets, life insurance, cash values, rental income properties, all that is in this kind of cash flow analysis. So someone can really in one shot see exactly what sources of income are we drawing, or what sources of pools of money are we drawing from every single year in order to supply them with that retirement income. And so that kind of goes into the next part, and that is, yes, a financial plan also talks about which sources do you draw from first. Do you take your CPP early? Do you RIF using your RSPs? Do you RIF first? Do you use your tax-free savings account first? Do you use your non-registered account first? Do you try to push everything off for your RSPs and use cash values and life insurance? So there's all these questions that this financial plan answers, and all the scenarios explain in great detail what is going to be the most optimum use of their money. So that's the most important. That's one of the most important slides. The next slide really just talks about financial assets. And so how is this helping someone? Is that's really sharing with them, will you actually run out of money in retirement? And if you wanted to draw the maximum you could out of your portfolio, your investment products over a certain period of time, how long would it take for you to expire that if you drew, say, over the next 25, 30 years? How much money could you get out of your portfolio? Not taking into account taxation, just talking about how quickly would it take. So you can see here that blue line that is sort of arcing down. You're seeing here by age 90, we have it. In this particular case, where the client is saying, you know what, I'd like to spend all my money before I die. So that's kind of what that's showing. Even though they have other assets on the page that they're not spending, like real estate positions, personal residence, rental properties, all those are continuing to go up. So what it says to this client is you're going to be passing away with considerable amount of assets. And so we really should start talking about estate planning, how to minimize the taxation on your overall estate, to maximize the benefit of not just yourself, but also to whom your beneficiaries are going to benefit from all this cash, or having the real estate positions go intact to those beneficiaries instead of selling them for cash. Another example within this, and this is one of the ones I really love, And by the way, if you can see these slides, please let me know. Just give me a thumbs up. I want to make sure that you can actually view them and they look well to you. This particular part of a financial plan talks about 4 different areas, and one is your retirement options. So the first block, so the information above each blue line, solid blue line, okay, says how much money will your investment portfolio produce. Hey Shane, thanks so much for the thumbs up and letting me know. Great to see you on the live stream again. So the first option, number 1, says this particular person and with the assets. And by the way, I'm sharing with you not someone's actual plan. This is just numbers I put in just for illustration. So you can be rest assured that it isn't somebody else's financial plan. But what is this showing is that their portfolio can produce $137,000 per year. And it goes up with the cost of inflation, and it'll go right through to, in this case, it was age 90. But they only want $125,000. But we're saying you could go as high as 137. So that's like just another option that we say, here's what you could have if you wanted to. The second one is, could I retire early? Well, in this case, the person said, that's it, I'm out, I'm retired, I have enough money. Option number 3 is, what kind of risk do I need to take? Now, this is a really important question right now, given the fact that what's been going on with Ukraine and Russia, and seeing a lot of portfolios being negative year to date because of the types of allocations. So you might have maybe more heavily weighted into the US than Canada. And so you're seeing negative returns. This is just temporary. As we saw the last 2 days, the markets have been up amazingly so. And so you can see that the appetite for the markets to move forward once the conflict is resolved is really going to push the markets a whole lot higher. So in this particular case, this says to someone, do I really need to get 10, 12, 15, 20%? Or what is the sort of the floor? What is the minimum that I need to get in terms of a rate of return in order to make sure that I can take $137,000 a year plus inflation, or plus the cost of CPI going up every year, and make sure that I'm never going to actually diminish. It's not, my portfolio is not going to diminish, or my portfolio wouldn't supply that amount of income. So you can see here the rate of return, the difference between 6.21 and 7%. It's not a big difference, but essentially it's saying, look, if you get this rate of return for the rest of your life, you can have 137,000 for the rest of your life. So it tells people they don't need to take unnecessary risks with their portfolio if a lower return can keep them where they want to be in retirement. And of course, the last number, and that kind of goes to the question is, will I have enough money to retire? A lot of people say, well, what is that magic, like, big pool of money? And in this particular case, we see exactly here the required amount and the current amount. So the required amount is about $2.5 million, and their current amount is going to be slightly higher than that. So it tells them they've actually got more money than they're ever going to need in retirement. So in one slide gives 4 pieces of data that helps someone to actually make a decision about retirement. Is it the right time? Do I have enough money? Am I on track? Is it sustainable? That's the power of a financial plan. And so I encourage everybody to get a financial plan. All of my clients get financial plans, and they get another document too, and that is a dashboard. And I'll share that with you in a minute. So a financial plan removes the most amount of anxiety around retirement. I see it every time when I deliver financial plans to clients, and you just see their shoulders drop. You see them start to take deep breaths, and it's a signal to me that we're on the right track and we're doing the right work. Here is the dashboard. Every client gets a financial dashboard. So some of those slides that I just shared with you are part of like 20 pages of information. And then I take the most important pieces of information and I put it on a dashboard. And these are very particular to you. I'm not going to go through each slide, each section here, but they're fairly particular to your situation. You're telling me, here are the areas that I want you to help me track, manage, and achieve. And we put that in 1-page slide so that you don't have to go through 20 pages of a financial plan to answer that question, will I have enough money to retire? This one page tells you your rate of return on your portfolio, how much money that I've made for you since we began working together. What is the total assets that you have right there in the center of the page? How is it made up? Because a lot of people say, well, I'm worth $2 million. And they say, well, your house is 1.8 of it. So you got to think about how you're going to retire. You might have to sell your house. So this is so important in that the bottom left-hand corner shares with the person how much money. This is the most important part of your financial plan. It's not your rate of return. That's not what retires you. It's how much income you can get out of your assets at retirement. And so the bottom left-hand corner tells the client, your portfolio is going to produce this amount of money every single month or every single year, and we're going to try to grow that as we work together. Okay. I'm going to move on to the second one, but before I do that, I just want to have a look at Rosemary's question. Okay, Rosemary, if it's all right with you, I'm going to share this question with the audience. For a TFSA account, when both spouses die, does the money transfer tax-free to children, or does it go to estate as a taxable income? Great question. I love estate planning questions. Okay, so this is not as complicated. Let's see if I can get this out of the way. Go like this. I'll put this here. There I am. Okay, this is not a terribly complicated question, but maybe I should back up a little bit. First of all, I would encourage you to go see the videos on YouTube that I have on tax-free savings accounts. That would answer that. But for anyone right now watching, I'm going to share sort of the Cole's Notes. Is Cole's Notes still around? I don't know. We'll see. I think anybody, Ivan and Shane, you guys probably remember Cole's Notes. Okay. If you back up and you say, take a tax-free savings account, and when you open a tax-free savings account, you put a beneficiary. And so typically if you have a spouse, you would name your spouse. And two ways to name a spouse is either a successor holder or just as a beneficiary. Now, the differences between the two, as a beneficiary, let's deal with that one. A beneficiary means when that spouse passes away, the money that's in the tax-free savings account would be given to the spouse. Okay, so as a beneficiary, though, what would happen is it would be paid out as a check and then given to the spouse. As a successor holder, so that's not entirely great because then it comes over as non-registered money. But as a successor holder, the money then becomes part of the survivor's TFSA. So there's no disposition there. Money just transfers laterally the same way as an RSP would roll over to the spouse. Now, if you don't have it set up that way, there's no sweat. There's a form that you can fill in upon the passing of the individual where you can have, if you had only named yourself a beneficiary, your spouse a beneficiary, you can then designate the survivor as the successor holder, and you have to do it within 30 days, and then you just move that money over. So there's still a provision to be able to get it done if it's not named that way, so it's not a big issue. Now, the next part of your question, Rosemary, was really around what happens when both spouses die and you have tax-free savings accounts. Well, similarly to an RSP, you can only roll over money to a spouse in an RSP in a tax-free savings account upon death. So when you both die, there's no spouses left to push that money to the next spouse, right? So it goes to your beneficiaries. So what you would want to do is you want to have secondary beneficiaries. So you would name your spouse as the primary beneficiary, and if not living, then otherwise it would go to the following names or charities, whatever you want. So in this case, what would happen is let's say it's $100,000, okay? $100,000 would be, now I use segregated funds for all my clients. You know that I use segregated funds because of the state planning properties within segregated funds. But what would happen is the money, a check would be cut and it would be issued to the beneficiary. So let's say you had 2 children and you wanted to divide it equally between the 2 children. So 50,000 would go to one child and 50,000 would go to the other child. Now, if they're adult children, it's just given to the adult children. If they're minors, then you have to have a trustee named, and that person can be anybody, and they are working with whomever the financial institution is in order to make sure that that money goes to the children as they need it. And then also, once they become a certain age, you can either say that in your will, when they reach a certain age, I want them to have so much or all of it. But essentially, to answer your question, the money at the death of two spouses, the money goes to the beneficiaries because they're named as a beneficiary. If there's no secondary beneficiaries named in the account, then the money goes to your estate. And that's not what you want to have happen, because the moment it lands in your estate, you're going to pay probate tax. Now, in Alberta, there's virtually no probate tax, but in every other province, there is probate tax. In Ontario, for instance, it's 1.5% of your total estate above $50,000. So you can see that starts to add up. Then the executor also gets to take up to 5% of the money that's in the estate. So they get paid four ways. I'm not going to get into that, but it works out to about 5% if they wanted to take that as a fee. So that's how that works. Your money would be not taxed, but it would go to the beneficiaries. But as a side note, as I always give so much information. A tax-free savings account, if it went to your estate and then it wasn't dispersed in a timely manner, then your estate's earning money on that money sitting in the estate trust account. So that's where there's tax, but it's usually the estate usually eats that tax on behalf of the beneficiaries of the estate. Okay, hope that helps. Hope that was a good explanation to that question, but good question. Thanks so much. Okay, let's move on to number 2. Oh, I guess we had one more slide. So here's some information around, if you'd looked at just an account and you had it well diversified, if you took $1 million, this is using the 4% rule of thumb. And again, I'm not a huge fan of this. Is just to help you to get to an area where you start feeling better about your portfolio. But let's say you had $1 million and you had it invested in cash. That's a green circle there. You can see that the money doesn't last as long. If you're withdrawing 4% of your money every year, it doesn't last as long as the other two, which are well-diversified portfolios. So a 60-40 split, and then the third 60-40 split is actually splitting up the equity in a much more advantageous allocation. So you can see that with a well-diversified portfolio, your money lasts much longer than if it wasn't well-diversified. So I thought I'd put that up there just to help you out, to make sure you're well-diversified. Okay, number 2, investing in life insurance. People were asking me, and I think the reason why we're getting more inquiries around using whole life or participating life insurance is because people are seeing through the pandemic, a lot of people passed away. And there was delays in getting estates resolved. The courts were behind. Huge taxable situations for a lot of people because, the markets have run up, real estate prices have gone up, and people are facing severe tax issues with their estates. So, and with market volatility that we've been seeing of the last, 2.5 months, people are now seeing the value of having life insurance as just one of the types of alternative asset classes in their portfolio. So you think about investing in real estate, and then you've got fixed income, and you've got equities, stocks, right? And then you've got life insurance. And so life insurance can be one of those wedges in the total pie of your investment, so that you're more diversified. And so why are we using life insurance? Because it's the turtle. It's slow. The rate of return is low. The cash value and the cash growth is stable. It's easier to plan with because there's almost zero, I won't say zero, but there's very little fluctuation or volatility in participating life insurance cash value growth. And so you're able, as a planning tool, you're able to use it much more effectively because you actually will know pretty accurately how much money you're going to have in the future. So let me dive into this, and I'll share with you how this works with one slide. I love it. This is great. And I share this. I said this in other videos, and I share this at seminars and workshops. People are ready to throw the cutlery at me off the table. So I always say, please put your cutlery away before you read this. Okay, we're going to compare on the left side of the screen a regular type of segregated fund or mutual fund, non-registered investment, comparing that to permanent life insurance. Okay, so let's just focus on the left-hand side of the screen. In this example, we're depositing $1,000 per month into typical mutual fund segregated fund. And you do that for 20 years. That's $240,000 over that period of time. But because you're investing that money inside of the fund, you're going to have to pay tax on the growth of that fund. And so that's the thing pulling back against you on your growth is the tax you have to pay. Then very specifically, and the way we use this very specifically, we're saying, I would like to deposit so much into a life insurance policy that by the time I reach this age, I want to draw out of it so much money that will last a certain period of time. It's a very specific strategy. And so in this particular case, we're saying when this person is 71, we're going to draw the maximum they can each year out of the life insurance for 15 years. And why we're saying that specifically is because the average mortality rate in Canada is 86 years of age. So 15 years gets them 86. Okay, so that's how we're going to use both these scenarios. So person, again, $1,000 a month into a mutual fund or segregated fund, non-registered account, pay tax on it every single year. And then at 71, we draw out enough money that will actually deplete their portfolio over a 15-year period. So that comes out to almost $500,000 over that period of time. Person reaches the age of 86, passes away. You see at the bottom of the screen on the left-hand side, there is $0 going to their beneficiaries using a typical non-registered portfolio. Okay, let's shift to the right-hand side of the screen. Using a life insurance policy, same thing, $1,000 a month goes into a life insurance deposit into a permanent life insurance policy, $240,000, same dollar amount, but there's zero tax inside of a life insurance policy. That is the tax laws in Canada. That's why we're the envy of so many countries around the world that we still have this in our tax code. And so you get to allow the money to compound growth. This is what everybody wants. You get that inside of life insurance. So you actually grow the cash values higher than you would comparatively in the life insurance than you would have if you had just left it in a non-registered mutual fund or segregated fund. Same timeline, age 71, draw out the maximum. Well, in this case, they draw out almost $550,000, so extra $50,000 over that same period of time. They pass away, and look what happens at the bottom of the page. They pass away and give $1.3 million tax-free to their beneficiaries. Same dollar amount going in. Invest in the same amount of money that you already had. One type of product versus another type of product produces completely two different results. Absolutely astonishing. Different results. And so you might say, well, why doesn't everybody just use whole life insurance? And the reason for that is very, very simple. One, you got to be healthy. If you're uninsurable, you can't do it. Two, you have to have sustainable cash flows every single year to pay for this. If you can't pay for it 1 year, it's like a mortgage. What happens if you stop paying your mortgage? They take your house away from you. So you got to make sure that you're paying into this every single year. And you can structure this to pay over a short period of time, like 10 years, and then stop paying, or you could pay the rest of your life. You can actually set it up really in a flexible way. So life insurance, if you meet the ideas of being able to be insurable and you have cash, a sustainable cash flow, or you're just sitting on, you sold your house and you've got a lot of cash, this is an excellent place for you to put money because you're not being taxed on the growth of this. So business owners, corporate people who own corporations will take their money from their corporation a little bit every year and put it into corporately held life insurance so they don't have to pay tax on the growth. That it helps them avoid passive income tax. Okay, hope we're doing well. How are you guys liking this content so far? If you like it, please remember to like and follow and share this with everybody you think needs to see it. And we're going to move on to number three. Number three is when to start my CPP. This had some of the most questions around CPP, most views around CPP. And so obviously I wanted to include this. And so I'm just going to share with you first this slide. This slide, if you haven't been onto my YouTube channel yet and seen all of the CPP videos, please go ahead and look at that first. That would be useful. Okay, answer your question, when's the best time? Well, the optimal time is around 72, 73 years of age. This slide is actually the break-even point between taking CPP at age 60 versus taking CPP at 65. You can see the red line, the orange line, and blue line where they intersect. It's around 72, 73 years of age. That is where if the optimal time to take your CPP. So hope that answers your question real fast and you don't have to wait 25 minutes for me to answer it. But let's dig into this, back to this retirement timeline. This is important. If you take CPP early at age 60, you know that you're going to have less CPP. If you take it at CPP at age 65, then you're going to have around $21,000 of if you have the average amount. So it's important that you understand how much CPP you're going to have in retirement. And the way that you do that is, first of all, you get either on the internet, you can look it up online, or you just call Revenue Canada. They have a line dedicated to CPP, and you just gotta give them some information over the phone. I did it myself. It literally took the person less than 10 minutes to tell me how much CPP I was going to have if I continue to contribute the maximum every year to Canada Pension, that I would have X dollars at age 60. At age 65, they gave me the entire breakdown in less than 10 minutes. And I had to wait a little bit of time because of COVID. It was a little delayed, but once I was on the phone with them, 10 minutes, and I got everything I needed to know about. Just check some more questions here. You remember, if you have any questions, you can go ahead and lay those on me, and I'd be happy to share that with you. I think we're done. That is the top 3 questions that I have for you today. Those were the top 3 questions I had all year long. Will I have enough money in retirement? How does whole life insurance work? And will it be useful for me? And when should I take my CPP? I'll just wait a minute just to make sure there's no other questions coming in. And I always tell people we take care of your wealth management so you can take care of what's most important to you. I hope you're having a fantastic first quarter of the year, and you enjoy the rest of the good weather to come. And I wish you all the best. I don't see any more questions, so I'm going to end it right now. You're welcome, Rosemary, Shane, and Ivan. So great to see you on the call tonight. And I look forward to seeing you guys next Wednesday in the live stream at 7 o'clock. If you have any questions around financial planning, please go ahead and send me an email or on any of the social media accounts you can reach me. Just looking at this. Thanks, Shane. Appreciate it. And we'll see you next Wednesday at 7 o'clock. Again, thanks again for tuning in. Take care.